Okay, it is 11 o'clock. We can get going, I think. So I've got a tiny bit of news to do this week, and then Richard's actually got some more interesting things. And then I'm going to be talking to Ken from Strategic Equity Capital. So my bits of news first. Premier Miton and HydrogenOne, both tiny. This is properly tiny now, the Premier Miton Global Renewables Trust. So the market cap of the ordinary shares is at just 19 million. So the fund's bigger than that because of the split cap, as we explained second. And it's split between ordinary shares and zeros. And those zeros need to be repaid on the 20th of November. And those were issued 5 years ago, providing finance at about 5% per annum. And when they were issued, the assets were enough to cover the repayment of those 2.4 times. Things haven't quite worked out that way now. If they were going to try and replace those, if they were going to try and soldier on, they'd have to pay an awful lot more for them. I mean, the EJF zero that just issued came at 8.5%, and that's despite the fact that it was covered 3 times. So the board has understandably concluded it's got to wind up the trust. So shareholders are going to be offered the choice of cash at NAV or a rollover into an open-ended fund with a similar-ish mandate, but it's not the same. So the Premier Miton Trust has been through a series of incarnations of different sort of things. This is sort of hiking back to sort of what it was a few years ago, which is sort of more infrastructure and utilities mandate and a much lower yield, so 4.1%. Now, I've put these stats up here, and this is probably the meat of what I'm trying to say, really. You can see that the trust has been pretty poor. I'm looking at especially the 5-year numbers there. The open-ended fund that they're proposing as a rollover vehicle has done a lot better and has outperformed its peer group. So that's the investment association sector. But if you look at the Ecofin trust, which is the one that Premier Miton Global Renewables sits alongside, it's in the same peer group. It's done way better than all of them, and it's the only one that's beaten all of these indices in NAV terms, at least. It hasn't done in share price terms, and I think that's kind of the point of why I think it makes a good rollover potential. So there'll be a circular published soon. Obviously, there'll be votes around this. I'm assuming people are going to vote to approve this, so the whole thing would happen in December. Anything might happen between now and then, but I would recommend at the current stage that you basically take the cash and roll into Ecofin, because you'd be picking Ecofin up on an 8 discount. It's got much better performance. The yield's about the same. It's a little bit less than the open-ended fund, but it has got a track record of growth. And I just think that's probably the better option. But there we go. HydrogenOne Capital Growth, the assets nominally are a lot bigger than the one we've just been talking about, but the market cap's only 33 million, and that is because of the very big discount. And it's obviously been struggling for a long time. So what happened yesterday is the shares got suspended. And the reason is the new manager and the board are not yet ready to say what the end of June NAV is. And they don't think they'll be in a position to do that until at least late October. And so they can't publish their interim accounts. And so they have to suspend the shares because of the FCA rules. What they're saying is there's a material uncertainty about the trading position of 4 investee companies. So these are all early stage things. All of them, were acquired on the basis that they would sort of not all of them profitable at the beginning, not all of them had sales at the beginning. So some of them still need funding. This is still an early stage investment. And we're in various stages of negotiations for funding for those. HGen was always going to be disadvantaged because it hasn't got the cash to participate in this. So there's a pretty strong risk of being diluted. But the interesting thing is that the board is saying there's a material change, for the worse since the end of March. And they also said that there were delays in the provision of information from the previous managers, and that's one reason why this has all taken too long. They've got about £1 million in cash sitting on the balance sheet, which is enough to keep going for a little while. They're looking at selling one of the investments, so they're also looking at debt funding. Now, I think debt funding is a bit of a strange idea. Maybe they're just thinking that if we do need working capital and we can't sell anything, then maybe we'll dip into debt until we've sold something. That would sort of make sense, but I'm not particularly a fan of it gearing up at all. Right, that's enough for me. I'm going to hand over to Richard. So 1 second. There you go, Richard, all yours.
Cheers. Right, yeah, so a couple from me, conclusions of strategic reviews. So firstly, PRS REIT. So here's its chart. And it's sort of familiar territory for investment REITs and real estate companies, really. So discount widened, and then you see the spike in the middle of last year, and that's due to shareholders requisitioning the board, and that resulted in the chairman being replaced by Robert Naylor and Chris Mills, who are the guys behind who are behind Achilles, and they've gone in and turned around a couple of trusts recently. That prompted a strategic review. It put itself up for sale in October, and then action really started happening sort of this summer. So in June, it received an offer from Long Harbour at 115p per share, which I thought was too low. And it turned out that that company hadn't even secured funding for it to conclude the deal or anything. So that seemed like a non-starter anyway. And then last week, share price jumped because there was press speculation about KKR coming in with a bid. They confirmed that they were in discussions on that, so everything looked good there. And then earlier this week, it announced that it accepted a bid from Waypoint Asset Management, who are on behalf of some UK local authority pension funds, putting a bid for the company. That was at after costs around what Long Harbour had offered way back in June. So 115.3p a share, which, as I said at the time, I think is too low for this. So it's the sale of the holding company. So if it goes through, they'll liquidate the REIT and distribute the net assets to shareholders. They propose this being completed by the end of November, and the dividend that's due in November will still be paid to shareholders. And it's saying it's accepted this because it's not received any proposals that are better than this. So I can imagine the negotiations with KKR haven't really come to anything, or they don't see it coming to anything. And they say it provides greater certainty and that cash will be returned to shareholders. As a part of the deal, they've agreed not to solicit interest from third parties, but they can still engage with third parties if they do make an offer. So it's still not out of the realms of possibilities that a counterbid could come in. And they also interestingly put in a break clause. So if they do go with a counter offer, they'll have to pay Waypoint 5.7 million, which is interesting. So will there be counter offers? I don't know. With that break fee, it would have to be above 118.7p. So it could happen. The share price is still way below what the bid price is. So I think shareholders are skeptical whether a fresh bid will come in. And like I said earlier, this is way below the NAV. I know this NAV hasn't been updated since December, but it's still a hefty premium. And I've said it before, I like PRS REIT. I liked what they were doing. They basically build houses for rent, and it's a sector that's got massive supply and demand characteristics, good, which we all know about in the residential sector. So it was just a shame that the board decided to offer the manager a long-term contract, like 3 years, which obviously put the backs up of shareholders and led to this. So I hope there is a counter offer that comes in and some kind of bidding war and shareholders get more, because I think this still undervalues the company. Next is Life Science REIT. So we talked about this before. It's launched in sort of end of 21, and it's just been a terrible performance since then, really. So it's on a discount of almost 50%. Basically, the concept of the company was to buy and develop, or buy office buildings and redevelop them into lab spaces, and they could get a massive markup on rent between office space and what they could charge life science companies, and then obviously the uplift in value from that. So it all came from a good place, but the market's just, the life science market's just crashed. The funding isn't there, and therefore the demand isn't there for tenants. So they've really struggled to put into practice their strategy, and so they've discount has widened and widened and widened. Obviously, we've had the interest rate rises and things like that, which have been a big burden for them as well. So they launched a strategic review earlier this year. They came out today saying that the outcome of that, they're going to pursue a managed wind down rather than the sale of the company. They have been talking. They've had offers or potential offers, proposals put to them, but they have come to a conclusion that selling the portfolio sort of piecemeal over the next 12 to 18 months would garner greater value than if they were to take one of these offers that have been proposed to them. So they've obviously got confidence that they can do this, and they've had proposals for a couple of their assets during this strategic review. So that obviously gives them confidence that there is a market out there and investors out there for this for their stock. And they also say that within the next 12 to 18 months, which is the period they reckon they can get this all concluded by, they'll be able to enhance the values of some of these assets with new lettings and other sort of asset management initiatives. To do this, they'll have to amend the investment policy, and they're looking at sort of the management fees as well to incentivise the sales, and that will need shareholder approval. So the reaction today, the share price went down in early trading sort of 1%. So you can see that that shareholders probably don't approve of this too greatly. They probably want their money back quicker. And interestingly, Saba is on the register over the last few weeks, and yesterday, it was announced today, but yesterday they upped their stake to almost 6%. So it'd be interesting to see what they will make of this and what will happen there. Just quickly on the portfolio, so they've only got 5 assets in what they call the Golden Triangle, which is of the life science sort of industry. So that's between Cambridge, Oxford, and London. It's valued again at December valuations was 385 million with taking off debt. So their net assets is 262, and like I said, their market cap's way below that. So they'll be looking to get as close to the book value as possible. So there's 2 in London, and this just shows how they haven't been effective in their strategy, really. So with the converting the lab space, so with Herbrand Street, for example, they recently did a deal with the original office tenant there to let that up again to them, so renewed that lease. So they've obviously given up there. And the big one that they've got is Oxford Technology Park, which is still being developed, sort of new blocks and new buildings there. So that's probably why they want to do this, to get a couple more of them out the way and let, and the value of that will obviously then go up when that's done. So, like I said, we're waiting to see. It needs shareholder approval. We'll see if that goes through, or whether they will push for a sale of one of the offers that's on the table. So, watch your space, really.
Brilliant. Thank you, Richard.